Hey, this is Chris. Now, a concern we've been hearing from some of our clients over the last year is whether they should be considering selling their investment property now that interest rates are going up and that interest rates are so high that the rents they're getting from these investment properties aren't high enough to make up for the interest that they're paying. And I think it's a very good and real concern to be thinking about, and I wanted to suggest a few ways to be thinking about it and a few different considerations to take into account. Now, the first consideration, is one that's, a bit of a unique tax consideration in Australia, which is this idea of negative gearing. So a lot of properties probably over the last few years, because interest rates have been quite low, have been positively or neutrally geared because interest hasn't been very much on these loans, and they haven't been able to write off essentially the difference between the interest cost and the rental income from your salary, which is a great tax benefit. So while this has been a disadvantage over the last few years, now with interest rates being higher, there is an opportunity for more people potentially to be negatively gearing their property, which is a common term, but really just means that the income you're earning from that property is less than the interest you're paying. So if you're on a high marginal tax rate, there can be some benefits of this because you can actually reduce your taxable income. The disadvantage obviously is that you are still losing money. So if you're only earning $25,000 in rent, for instance, but you're paying $50,000 in interest, although you can essentially write off some of that loss off your income, you're still losing money and it's not a great outcome. Which brings me to the next point that you really need to be thinking, am I going to be earning enough of a capital return on this investment to make up for the deficit that I'm losing out on every year because my rent isn't paying for my interest? And so that's probably the second consideration is, am I confident enough that the price of this property is going to go up enough over time to make up the difference? Because otherwise you're locking in a loss year after year after year. I think that's one of the big uncertainties in the property market is, are prices going to go up to make up that difference? And so some other considerations you can take into account are, how can you actually close that gap a little bit? So one opportunity you have is to raise rents, for instance. Now in some cases or some areas it might be easy to do that because there is a lot of people looking for houses, vacancy rates are quite low, you might have a lot of pricing power. But actually what we've seen over the last 6 months or so is a lot of regional areas in Australia, rents have been falling as more people have been going back to offices and less people have been able to be working remotely. So although you may have pricing power in some areas, it doesn't look like rents are going up fast enough to probably make up the difference. Your next option is just holding for the long term. So accepting that you're going to be losing money by holding this asset and paying a lot of interest over the short term, but hoping that you can, over the long run, recover that through house price growth. Now, certainly over the last 20 or 30 years, growth has easily made up for periods where interest rates have been higher and rents have been lower. But the next 20 years is a whole different kettle of fish, and no one really knows whether that's going to be the case. We've been in a world where interest rates have been falling for the last 30 years. In a world where interest rates continue to rise or at least stay high for a while, it may be harder to recover the difference between those two. Which brings me to the last consideration is, should you sell that investment property? Well, in some cases it may actually make sense, because by owning an investment property, and particularly one that's leveraged, which means that you don't own the whole house, you have a mortgage and you own a small part of the equity and then you have a big loan to a bank. The problem with a leveraged investment is if that asset price falls, you're magnifying those losses as well. And that could be compounded by the fact that every year you're also having to pay a high interest rate and not receiving enough rental income to make up the difference. So, what this is exposing at the moment is that investment properties, aren't a guaranteed return, and they aren't a guaranteed positive return, and for some people they can be quite financially damaging because you're actually leveraging up an asset that actually has a negative return. And so for some people, I do believe it's a consideration at the moment. Should I really be hanging on to that second and third property where I'm not getting the benefit of being the owner occupier and the capital gains relief for being the owner occupier, and the negative gearing doesn't stack up versus the loss I'm taking each year?